I'm Stacey West, and today I'm joined by Nick Clay, manager of the Redwheel Global Equity Income strategy. Nick, thanks for joining me.
Thanks for having me.
So, investors have historically balked at dividends as a sign of declining growth prospects. Yet, when Meta recently released their dividend announcement, the stock went up. So, is this view changing?
I don't think so. I think the beginning of dividend payments from Meta and some of those other very large Magnificent Seven companies, it's just a token attempt to pay a dividend. And if I was really cynical, would be an attempt for them to just be able to find themselves in more ETF products and be able to be applicable to even more passive vehicles out there, i.e. growth, value, dividend, etc. The reason why I think Meta bounced so aggressively off what had been a weak year in the share price return was purely that they cut costs dramatically, so margins started to improve again, and that then they caught the wave of the AI euphoria that has come through in the market. I don't think, I'd love it to be, obviously, but I don't think it's because they started a dividend that made their share price go up to 300% or whatever the earth it's gone up from the low. That would be wishful thinking on my behalf and would make all my companies very attractive. So I think it is just a token gesture. It's a token gesture from a lot of those big tech companies. They are using far much more of their money to buy back shares in their companies, something we do not look at as an attribute in a company that we think is important. The reason for that is that most companies do share buybacks at the wrong time, at too high a share price. It purely offsets option dilution within the company, not reducing the share count. And so it's not an attribute we look to, but it's still very much the main way, particularly tech companies in the US, try to return money either to themselves through their option schemes or sometimes to their shareholders.
And just on technology, briefly, it makes up around 20% of the portfolio at the moment, I believe. And I think that's mostly within semiconductors, which is obviously a beneficiary to the AI theme. And given that we've talked about the Magnificent Seven, which includes NVIDIA, and this theme more generally, do you see more opportunities in this sector coming through, or will it be difficult for you to gain exposure, given that you're kind of taking a more contrarian approach in some cases?
It's more the latter. Certainly, you're right. The strategy's positioning in technologies is predominantly through semiconductors, so TSMC, Qualcomm, Samsung, which is a bit more memory as well as some semiconductors. And until this year, to be perfectly honest, none of them had particularly been impacted by the AI euphoria. They've been left behind. And it's why we were able to hold them within the strategy. They were still yielding plenty enough. Their valuations were not expensive, despite the fact that there seemed to us to be an obvious link between, if the future of NVIDIA was to be true, well, then surely these companies would have to benefit. TSMC make the chips for NVIDIA. Samsung, along with Hynix, provide memory to allow those chips to actually work. And Qualcomm allow those chips to happen at what's called the edge, where we are, in our computers, in our phones, in our cars, in buildings, etc. And therefore, they seemed like an obvious beneficiary of this trend, were it to be true. And just more recently, in the last few months, that has become recognized. That has therefore meant those share prices have gone up quite a bit, to the point now where we're starting to think that those valuations are getting a bit excessive. Now, what's one of the sort of safety nets we have in place in this strategy is we have a sell discipline as well as a buy discipline. So we can only buy stuff that yields 25% above the market before we can buy it. But equally, we have a sell discipline that means we have to sell everything that yields less than the market in the portfolio. The world market today yields a mighty 1.8%. And therefore, anything that yields less than that, we have to sell it. And that's sell discipline is deliberate because it protects us, being human beings, which means that when TSMCs and Qualcomms, when they start to go up and up and up and up and get more and more and more expensive, quite frankly, we fall in love with them. We think, well, look how clever we are. We found these stocks, they've gone up a lot. And also you fall in love with the story and you fall in love with the growth that's coming through. And we start to think these are the most incredible companies. And it's exactly at those times when the risk in those companies is becoming the greatest. And you need to be able to recognize that. You need to be able to sell them, take capital out of those companies and recycle it back into something where your risk reward is more skewed in your favor. But as a human being, it's really difficult to do that, particularly when everyone now talks about them in such great light. And so those two stocks, they're starting to approach yields which are falling below that of the market. So if they carry on going up as the way they have been going up this year, then they're going to trigger the sell discipline and we will be forced to sell. And we will be forced to look elsewhere in the world and within the market in order to find those ideas. And that's where we find ourselves today. There aren't a lot of ideas in the US. Well, not in the concentrated part of the US market, certainly. And within technology itself, the bit that's all gangbusters, AI and semiconductors, we think are starting to get very expensive. So we will be forced to move away and go and find something different. And that's why, this strategy has always had a differentiated approach of trying to generate a decent total return over time.
You also have a bit of a psychological discipline, it sounds like, with your buy and sell, taking out that human emotion that we're all subject to, whether we want to admit it or not.
Correct, yeah.
And
we certainly do not believe we're any stronger human beings than anyone else. Quite the contrary. I particularly very prone to emotions. And so, I can't do anything about controlling that. That's a futile exercise. So therefore, instead, we have to have objective disciplines that force us to do what we would consider to be statistically over time, the right thing, what's statistically attractive more often than not. We're still going to get lots of things wrong, and that will always be the case. But all we've got to try and do is get slightly more things right than we get wrong. And therefore, if we have a discipline in our process that encourages us to more often than not try to do the right thing at the right time, then that is to our clients' advantage. And that's what those disciplines are about. They force us to be patient and wait for a good company to become cheap enough. Something has to be going wrong with it before we can buy it. And equally, it also forces us to get rid of companies when they become very expensive and your risk reward is now skewed against you. And that's a very difficult thing to do as a human being. Every time we're buying something, we're told we're idiots because something's going wrong with that company. Surely you can see something's going wrong with that company. Why would you buy it? Why would you buy luxury retail today when the Chinese are not buying luxury retail? What fool would do that? Equally, when we're selling things, we're told we're idiots because, well, now everybody loves this company. Surely you can tell it's going to go to the moon and it's going to take over the world. Why would you be selling such a thing? And so it's a difficult thing to do as an individual, as a human being. It's uncomfortable, it's frustrating, it makes you feel stupid. So you need your disciplines in order to encourage you to do the right thing at the right time.
Well, on that note, your recent commentary for the strategy showed that you've been more active than normal. So why is this? Is this down to the discipline, the buy and sell that we've just talked about? Or is it just there's so much controversy out there that you just have loads of opportunities and you're just kind of having a field day? What's happening at the portfolio at the minute?
There's always plenty of controversy. We are never short of a good bit of controversy to be able to find ideas. So it's not that we're ever lacking for idea generation. What's been interesting is that the very narrow and concentrated focus of the market has meant that certain stocks in the portfolio have gone through their sell discipline. So Sage, another technology company, was an example of that more recently. And of course, that forces us to have to recycle that capital. And then what we found interesting, because the market's been so narrowly focused on one area, lots of other parts of the market have sort of been left behind. And yet they have characteristics that we are trying to look for. When we think of the range of outcomes that we face, we have no idea what the future holds, but you think of the range of outcomes you face, and we think of that as a range rather than certainty. I mean, we would say the market today is obsessed with certainty. Only one thing's going to happen, which is this beautiful version of Goldilocks that's going to happen. And yet we think there could be other things like a recession or like a return of inflation. And so we look for the characteristics in our companies that can suffer that range of outcomes. And we find that available in quite a lot of places at the moment. So particularly in insurance, where interestingly in America, those insurance companies have recognized that they have pricing power. You can put up your insurance premiums. Insurance, particularly in motor and household, is a short cycle. Every year you renew your insurance policy, so you're able to put your prices up quickly. And in most cases, it's legal, so you have no choice but to pay those higher. So it's a great environment. Well, in America, that's been recognized, and the share prices of things like Progressive, et cetera, have done very well. Whereas in other areas of the world, like in the UK, they've been left behind a bit. So, fairly recently we bought Admiral, which is a car insurance company. But very recently we bought Beazley and Hiscox, again, insurance companies, more niche. Beazley is like maritime, doing ships, etc. But exactly the same dynamic, an ability to put up your premiums. They have pricing power and can therefore cope with an inflationary backdrop and or a slowing economic backdrop, etc. And those are the characteristics we're looking for. And so when we're forced sellers of stuff that's done well, like our Sage, those are the ideas that we've been being able to look into just recently.
As someone who has renewed their car insurance just this month, I can attest that it has gone up and there's not much you can do about it. So, right, just finally, I wanted to finish with the case for global equity income, but also this strategy in particular. What is it adding to an investor's portfolio?
So I think particularly at times like now, when everything is becoming very extreme, everything's becoming incredibly concentrated. Nvidia this week just got larger than the whole of the UK stock market on its own. It is now the largest company in the world. I'm told it's just surpassed Microsoft and Apple, which is an odd scenario that the person that makes the widgets for people to use to add value is bigger than the companies that are using the widgets to add the value. That's a very weird scenario. It doesn't really ever happen very often. And so you've got this strange concentration. And of course, what that does is it puts a great amount of pressure on investors and on clients and on fund managers to participate in this concentration, to participate in the rally in the biggest stocks in the world, because the whole of our industry is set up to encourage us to do this. And yet it's our fault. I mean, not my fault, obviously, but it's ours as an industry's fault, where I will say, I run a strategy and I take some risk to generate a total return for you. And then you will go, well, how do I measure that? And you go, well, here's a benchmark. You can measure me against this benchmark. And I take the risk, and here's your benchmark. So I've established now that this benchmark is the risk-free version of what I do. And I take the risk, and this is the risk-free thing. Well, then we build all our systems around that to measure my risk against the benchmark. Now, of course, when the benchmark starts doing this and becoming very concentrated, well, then all the risk systems saying, well, look at all your risks. You're taking way too much risk. And I can go to my risk systems and I can say, what's the riskiest thing I'm doing and what should I do about it? They go, well, just buy more NVIDIA. That's what you need, because it's the thing that's driving the market and you don't have it, and it's the biggest risk in your portfolio. And if you take that to a logical, if the benchmark becomes one stock, it will be say this is the least riskiest thing out there, and you should be doing. Well, of course, everything that gets turned on its head. And you're encouraged to get out of things that aren't that risky and get into the things that are the most risky, i.e., the benchmark today, because that's where we are today. And that pressure that gets put on fund managers to therefore capitulate and become closer to the benchmark, clients that capitulate to come closer to the benchmark, means that everybody becomes obsessed with one thing in driving your total return, which is the capital gains, the price is going up. And at that time is when you need to sit back and go, actually, what's more appropriate? And what is over the next 10 years going to be the more likely driver of your total return? Well, we go through these big cycles of what drives total return, from capital to the compounding of the income. And we've just been through a massive cycle of capital dominating. And we're probably going to go into a cycle where the compounding of the income dominates again. Valuations are really high, etc. And what's difficult from a client's perspective is to go, well, okay, well, if I want that balance, where can I find something that will compound the income for me to drive the total return and not the capital? At a time when all of the systems have gravitated everyone to herd into the capital part of your total return. And so we would argue that this strategy's disciplines, it forces us to only compound the income over and above the capital. We are not trying to beat the market in a capital sense. We are simply compounding a higher income, which, if we can get close to the capital return of the market, will generate you a decent total return. That's just the maths of it. And it's the disciplines that force us to have to do that. So at a time when everyone's investment thesis has crept, been pushed, being coerced by the systems to do one thing, we stand differently trying to do it in a different way. And I think when you take a step back and look at the extremes we are in markets and where, therefore, for the next 5 or so years, a return's more likely to come from, I think a bit of balance in how you do that is going to be very appropriate. And that's what we offer clients. So we do it differently because of our disciplines forcing us to do it differently. And I think that will be highly appropriate of what we see going forward in the next 10 years.
Thank you for coming to talk to me about quite a lot. Technology, obviously one of them, but then the structure of your fund with the unique buy and sell discipline and how that kind of translates for a client and what it looks like in a portfolio. So thank you very much for speaking to me.
Thank you so much. Thanks for having me.
And for more information on the Redwheel Global Equity Income strategy, please visit fundcaliber.com.